Hello traders, and welcome to lesson number 21 in the ReadFX Beginners Forex course. In this lesson then we're going to look at money management. So money management is a defensive strategy that controls the size of your trades to protect your capital during losing streaks. It can also be used to increase gains during winning streaks. Now that's quite advanced and I'll cover that in other lessons. So money management then considers the following points: your win rate, your risk to reward ratio, and I'm going to explain both of these points quickly in the next few slides, your account balance, your margin requirement. Let's have a look at win rate first. Now I will do a separate video where I go really in depth about win rates. If you don't know what win rate is, it's the percentage of your winning trades out of the total number of trades taken. So for example, if you take 100 trades, you have 50 winners and 50 losers, your win rate is 50%. The risk-reward ratio simply illustrates the amount of money that you risked relative to the profit that you made on a trade. For example, if we trade at $1 per pip and you have a stop loss distance of 100 pips, then your risk is 100 times $1, which is $100. Equally then, if your take profit is 200 pips at $1 per pip, then your reward is 200. So this gives you a risk to reward ratio of 1 to 2 because your reward is twice as much as your risk. Now I will cover this in depth in another lesson. Account balance and margin requirement. When choosing an amount to trade, you must take into account your account balance and margin requirement to open and maintain that trade. If you risk an amount that's too high relative to your account balance, you will run out of money during losing streaks and you'll be unable to trade. So let's go to the margin calculator and have a look. Okay, so here we are on the ReadFX website, and I'm going to go to the top and click on Forex calculators. Now if I scroll down, before I go to the margin calculator, I'm going to show you the lot size calculator. And this is because most traders, when they make a money management plan, they don't consider margin. They go straight to a lot size calculator and they work out how much they want to risk. So here I've set up a fairly typical sort of money management plan. They've got a $1,000 account and they've decided that they want to risk $50 per trade. Now, assuming that they have a risk reward ratio of 1 to 2, they're risking $50 to try and make 100. They want to make twice as much as they're risking. Now in this case that equates to 5% of their account balance, and we're talking about initial account balance, and we're going to assume that they keep risking $50 per trade. Okay, so it's 5% of their initial account balance, and they're not going to take into consideration the way their balance fluctuates up and down as they win and lose. Okay, so 10 pip stop loss, they need to trade a position size of 0.5 lots if they want to risk this $50 for this trade. That's fine. Now let's go to the margin calculator and have a look and see what margin requirement they actually need to place this trade. So if we scroll down, we can see we're on the Euro US dollar and we're with a US brokerage and they give us 1 to 50 leverage. Okay, we want to trade 0.5 lots, which means we have a margin requirement of $1,054. So at this point the trader realizes they can't even place the trade. So this is one reason why you need to check first. You need to make a plan and consider how much is in your account, what's your account balance, and what is the margin requirement to place this trade. Now in this case we can solve this problem by simply going to a different broker. So if we go to an offshore broker, we can now get 500 to 1 leverage. So let's calculate again, and we can see now that our margin requirement has dropped to $105 for this trade. Now let's think about this a little bit more. Most traders will have 2 or 3 trades open at a time. It's unlikely that this trader is using just Euro US dollar to generate all his trade ideas. He may be trading gold or the Dow or numerous pairs and instruments. So let's say he's got 2 or 3 of these trades on at a time, and each trade is at the same size and requires roughly the same margin. So he now has about $315 tied up just in margin. Now retail traders lose a lot of trades. Let's be honest, 80% of them, 80 to 90% lose everything. So when the losing streak starts to happen and he's losing $50 at a time, his account balance goes down and down and down to the point where he's going to struggle to even have 3 trades open. Okay, once you get on that cycle, once you're in that losing streak, the only thing that can fix it is a winning streak. So if you don't have enough money in your account to even get the trades on to win them, how are you going to recover from that situation? So it's very important then to consider your margin requirement, not just for this trade, but for future trades. What happens if you go on a losing streak and you lose a percentage of your account balance? Will you still have enough margin in your account to trade the way that you need to? Will you still be able to open multiple trades in order to catch that winning streak that's going to pay for the losing streak you just encountered? So these are the things that go into a money management plan. Now, I want to really illustrate what happens when you risk too much. So generally speaking, risking more money per trade is a bad idea. It reduces your ability to survive long enough to allow the statistical edge of your strategy to play out. So what do I mean by that? Let's assume that this diagram here is your equity curve. Okay, so this is your account statement. It's a record of all the trades that you've taken, and you can see that you've had some wins and some losers. Now let's assume that you risked a sensible amount, let's say 1% per trade. So we have a nice little winning streak here, and let's say we're up 3%. Then we catch a couple of losers and we're sort of up and down, and here we're up 5%. Okay, then we have a little 5% losing streak. Maybe this is maybe a 7% winning streak, and then we go through this period of win lose win lose. Now what I really want to point out is this section. So this is quite a big losing streak. Let's assume that this is 10%. Okay, so you've lost 10% of your account in this losing streak, and that is followed by, let's call this a 20% winning streak. Okay, so you make back the 10% you've lost plus 10% on top. So this is a fairly typical set of trading results. If your strategy has a 50% win rate, the chances are that your equity curve will look something like this. Now then, what happens if we increase our risk to 10% per trade? Well, you should realize straight away that this 10% losing streak we had when we risked 1% is now 10 times bigger. So 10 times bigger than 10% is 100%, which means that you just blew your account on the exact same set of trades where you would have survived if you'd risked less. And critically, you did not survive long enough to allow the statistical edge of your strategy to play out. In other words, you blew up here. You did not survive long enough to catch the winning streak that paid for the losers. And 9 times out of 10, when you risk more, this is all that happens, is you just magnify all of these peaks and troughs in your equity curve. So what was a 10% loss becomes a 100% loss. And this is a direct result of risking more per trade. So money management then is all about taking all of these factors into account and making a plan that allows you to survive long enough to make a profit. In this lesson then, we covered money management, and we looked at win rates and the risk reward ratio, account balance and margin, and risking too much per trade. In the next lesson, we're going to go in depth and look at win rates.